When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be discussing current event headlines. Then we'll talk about wealth preservation and risk management. We'll answer listener questions. And then finally, long-term care strategies for families with large estates. I'm Jeff Shea, just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff in this radio program. Of course, it will be Jeff Fogan of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. Always great to be with you and with the listeners. It's fun. Way to just get a lot of things off my chest.
Yeah, this is our time to vent. Pretty much every week I ask you a question, then you vent for 10 minutes or so. But it's always great to hear your opinion on things. So many retirement shows out there, and we're a lot more than just retirement, but you hear the same old boring stuff every week. So if you want to know what's going on currently in the market, you want an expert opinion, you are in the right place right now. I'll start by giving the phone number, Jeff, 520-780-9059. You hear anything in the program today that prompts your interest, you want to talk to Jeff about preserving your wealth or creating an income stream that you can't outlive, or you want to reduce taxes, again, that's the magic number, 520-780-9059. All right, Jeff, let's start with the headlines. We've seen the markets fall this week, particularly on Monday. I know that you were up very early, around 2 a.m., watching the markets. All three major indices were down. What's driving this slide, do you think?
Well, I think people are finally getting wise and know that it's overvalued, overhyped, and hedge funds have been sellers for a few months now. It's finally that Main Street is finally catching up. The other thing that kind of exacerbates the market, even though earnings have sort of been okay, I think the truth has come out recently that many of the companies, especially chip companies and tech companies, are not reporting depreciation fairly or accurately on their income statements, and they look like they're having bigger earnings. So generally, earnings you have to take the lifetime value of a product and depreciate it over time because you are using it up. There's a time you have to buy a new chip for your computer, a new processor for your whatever system, maybe new technology that's more efficient for your energy plant to fire up all the energy your data center needs or whatever. And some of these people are saying, oh yeah, with this chip will last 5 years, so we're depreciating it slower, which really kind of pads the bottom line and makes it look like earnings are better than they are. So I think there's a lot of trickery going on in Wall Street, nothing new there. You know, if Wall Street's talking or a politician's talking or just certain areas of our lives, you know, it's really angled to benefit them, not us. So we have to take those things in stride and understanding the context that they're delivered. And Wall Street always wants to win. But if we see what the net sellers are, I've been looking at one of the things that I always do to see what the market's really feeling is how much insider buying and selling there is. In other words, the CEOs and the C-level executives, vice presidents, directors, again, are typically very rich, wealthy people that run other companies or sit on boards of other companies. And they have the inside track on knowing whether or not their company's growing, declining, whether their earnings are real, whether they're fair, whether their growth is sustainable, et cetera. And we've seen in the tech side of things for the last 3 to 6 months, all I've seen is sales. There's very, very few buys. The only person that buys anything is Elon Musk. And I think it's to manipulate his own stock, and he'll buy it in billions of dollars at a time, which is kind of weird. But if you look at all the other executives at Tesla, they've been selling. If you look at Bezos and all the executives at Amazon, even Micron, which has had a big run in the semiconductor business, net sellers, AMD, Meta, Google's been on a pretty good run and still a bunch of sellers inside there. So all the tech stocks, we know the smart money's selling, all the while Main Street's getting hyped. And the other thing we talked about in the last few programs is how much volume is being generated by borrowed money, by the leverage that we get from margin accounts. And margins are, you know, in my case, I have a margin account. Sometimes I go a little bit over what I have because I want to buy a position and I have it available to me and I can see what's available to me to trade. And it's at least 3 times what I put in. So for every $100,000 I have in an account, I can trade $300 additional dollars. They'll loan that money to me at somewhere between 7 and 15%. So they're making money on loaning me money, and I'm hoping that I can day trade or make more on it in a short period of time than what the interest cost me. But Main Street investors have been doing that for a couple of years, actually several years since they started getting stimulus money, especially around the days of COVID, where everybody was sitting at home, didn't have jobs, didn't have anything, and they all decided to become day traders. And every time that the market had a dip, they'd buy and they'd borrow money. And so far it's worked out okay, but there comes a time, and I think we're hitting it right now, where you're getting margin calls when you have a stock. We've seen some of these big stocks, NVIDIA and others, that are down 20% from their highs just a month or so ago. A lot of the big nuclear stocks that have been on a run lately are fallen 20, 30% from their highs. And those companies were companies that doubled like in the last year or more, some several 100%, but we're seeing them give back a lot of profits. And what that happens, if there's a lot of these uninformed investors, or the looky-loos, or the what we call the tourist investor, which is basically Main Street household investors, not the insiders, not people that work on Wall Street, not people in my business who actually have access or pay for information to know what's going on behind the scenes, you get kind of I think if you listen to the news and you've done well for the last 4 or 5 years, you get this false sense of security, and these people keep buying. But when the market starts going down, they'll get margin calls, and they'll say, oh, hey, you have to sell 20% of your stock because you need to pay us back. That stock's down 20%, so you need to sell a bunch of stock. Well, you have to sell stock, but remember, for every, let's say the market goes down 20%, but you've tripled your stock purchases or even quadrupled them, you lose 60% potentially of your own money, because they call the margin on the other. So it's a double-edged sword. And what happens is the only way to raise the money to pay back the margin is to sell your stock. Most people don't have cash laying around at the bank, say, oh, I'll sell that CD and I'll send that money to you tomorrow. Shoot, it takes longer just to get out of the CD. And the margin calls usually want to be caught up by the next day, sometimes even by the end of the same day, depending on how tight your company is or who you're dealing with and what your margin agreement says. So margin has been it's exacerbated the gains, but it's going to really tear up the losses. And I've also seen that hedge funds, pension funds, big institutions have been net sellers for a long time. And you can look at Warren Buffett. For 2.5, 3 years, he's been liquidating. He's more than a third in cash, just waiting to swoop up deals of stock when they're dumped and when they're cheaper. And I don't think the stocks are cheap yet. We're looking at the Mag 7, the 7 big players that drive basically the S&P, and those 7 stocks contribute 50% of all the earnings, which means all the other stocks are pretty much break even compared to what the Mag 7 does. And if we look at what the Mag 7 has done just in the last week or two, and we look at where it's been, let's just say it's high, it's down about 8% in just about a little over a week. And that's the 7 stocks combined. Now we have a couple that are holding it up. Google's been doing well. Microsoft's been selling off. There's a lot of weakness in like Meta and some of these other companies. You follow the leaders, and the market typically will follow the leaders. Now, we also had earnings this week of NVIDIA, definitely disappointing to some. Some say it's okay, no big deal. NVIDIA is the king and it's going to always go forever. But the market reacts. And when we have companies that underperform, we're going to see some selling off. And so what we have to do is look at those areas that are getting left behind. We've seen some strength in healthcare companies, some relative strength in the healthcare world. Some of the value stocks are finally getting money going back into them, even the consumer goods like Colgate and those kind of things, Procter & Gamble, those things that are consumer goods that everybody needs on a daily basis and aren't going to give up until after they've given up their discretionary items. So we've seen consumer discretionary fall off a cliff, especially the high-end stores and things that deal in high-end discretionary products. Their profits are suffering. So what are we seeing? Well, we're seeing the market finally correct from its extremely overvalued position and go back to kind of a normalized market. I hope it finishes going to a normalized market. Now, I'm not saying I hope there's a crash, but when it goes to a normalized market, we've got to give up about 50% of the value in the overall indexes, which means some of the stocks that haven't gone up or haven't gone down will probably stay the same. But those that have been artificially inflated through margin accounts, excessive buying, excessive hype, are going to settle down into more realistic values, and it's going to drag the account down. So if you've got 401ks, you've got mutual funds, you've got some of these balanced funds that have all these blue chip stocks that have been going to the moon, be prepared to have a reset. So if you need that money, take those profits off the table. I think it's a good time. I just looked at a stock market graph, and it showed the 2 or 3 years leading up to the 29 crash and the approximate percentage gains that the market had made in 1929. That was the Great Depression, right? The chart that we have today is almost identical from the start to the finish, and we're right at where, percentage-wise, where the market and value-wise, where the market peaked in 1929. So if you think the market's different this time, the market never repeats, well, I beg to differ, because if you look at a lot of the historical corrections and you overlay the map or the graphs or the charts on top of old charts where conditions were the same, they all end the same eventually. Now, we did have kind of a hiccup in the chart if you do the overlay, and you can go online and find these charts. If you look at today's market over the last few years compared to the market right before the Great Depression, there is a bump right after COVID where everybody was buying the tech stocks. And remember, then there was the 2022 when Biden came into office and inflation started hitting hard, and then it went down. So we had this real fast run up, and then we had this correction that probably only made up half of the correction that we should have had. And then, of course, QE started again. They started bailing us out and printing money and faking us out with the interest rate situation and driving the market up again. So now we've got the market high. It's gotten back on that same track that looks like the pre-29 crash stock market. So if you look at history, and I like history because it tells me when I should be afraid and when I should be bold and courageous. And right now, I'm more afraid than bold and courageous as far as the opportunities to gain. Now, I am courageous and bold from the standpoint that there is so much information and ability to find out things like how many insiders are selling, what stocks are the institutions unloading. I don't want to get into those stocks. If there's still some buying and it's propping the market up, we can follow the money, but also we have the ability to transfer or to rotate into sectors that aren't as weak if we want to still try to make money in the market. Now, there's nothing also wrong with going off to the sidelines and not losing money, because you really make more money over the long term by not losing than by just riding it out ups and downs. And I know the market doesn't want you to hear this because they always say, oh, you can't time the market. No, you can't time it. You can't time it perfectly. And they also say, if you try to time the market and you miss the 10 best days in the stock market, your returns would have been 10 times less. But in order to get the 10 best days in the stock market, for example, some of the best days are after a 20 or 30 or 40 or a 50% market crash. So I can ride it all the way down and miss the 10 days. And if all I do is miss those 10 days, but I still get the other ones, yeah, I'm going to have a better overall return. But what if I miss the downs and I miss one of the best days, but I miss 100 days that make up twice as much as that best day? We can still do better that way too. So there's a lot of misleading data and a lot of misleading hype based on figures in the market, history, stats, things like that. And I remember my dad and a friend of mine's dad always said this, and I guess it's kind of an old saying, but I remember it vividly. It's like figures always lie and liars always figure. So you can always get a stat that supports your claim. A lot of the big market gurus, hedge funds and stuff do that as well. Some of the people you see on TV advertising and claim they're fiduciaries and stuff like this, they cherry pick their results. Oh, look at this period of time. We beat the market. Well, why don't you take your whole period of time over the last 20 years and see how you really did? You know, your fiduciary is supposed to be doing what's best for the client. Really, you could have just bought them an index fund and done better. Did you really do the right thing? In hindsight, you can always see whether you did or you didn't, but there's a lot of misinformation. There's a bunch of garbage and data and hype that is out there. And unfortunately, it's spewed by mostly the big firms, the big name firms that everybody just trusts because they're big. And the bottom line is they don't care about you. They don't care about the Main Street guy. They don't care about the household that's trying to make a living and work and save in his 401k for retirement. They don't care. All they want to do is say, how can we manipulate this market to our advantage and hype up stocks so everybody overpays for stocks? We sell into that hype. And then when they get scared and get margin called out of it, and they're going to do that, and they're going to keep it at a lower price, then we get that stock back at a much lower price. They basically force the dip, and they force themselves to buy the dips or buy the crash. And that's how Wall Street continues to get richer, whether the market goes up or down. The problem with the whole scenario is Main Street, the regular person, people that are just trying to make ends meet, the normal Joe, is just trying to get ahead, and they can't see things like this coming. So every few years, you get blindsided and you have to start over. And that can actually ruin a person's life, their retirement, or at least create some pain that they have to deal with through a retirement plan. And if you're trying to retire on your terms, you need to remember that protection is most important and making money is secondary. You should have been making money before retirement. If you're planning for retire, you're still heading there and you're still working, then you still need to take advantage of the upside of the market, the dips. You have a paycheck, so you don't have to worry about locking in losses if you are using that money, because you're not. But continue to take the free matches with your 401k. Continue to dollar cost average into the market. If you have some more conservative plays in your 401ks and other stuff, I don't think it's a bad time when the market's this overvalued and this high. And when you're starting to see some serious sell-offs where stocks are going on 5 and 10% in a day, multiple days after another, which we've just seen this last week or so. I mean, big stocks, good stocks, household name stocks. And these are blue chips. So these are stocks that a lot of people like to own. And if there's that many people selling these stocks that have hundreds of billions or even trillions of dollars in market cap, and they're going down, that means there's something serious going on. And it might mean, hey, you know what, we can just sit this next round out for a little while, or just maybe sit out the next month for a while until we see some sort of a foundation being built in the market again. But I don't see that right now, except for a few sectors in the market. And of course, we always rotate and try to gravitate to those. I think gold and silver has been very weak. I think it may get stronger as the tech stocks get weaker. Consumer goods, the staples might be a solid play. Healthcare seems to be continuing to go and grow, and health-related biotech seems to be the favorite. Now, I'm not giving stock tips. Don't take anything that I say as a stock tip. I'm just saying I'm seeing some less interest in selling those sectors. So those might be sectors that might weather the storm a little bit better than tech right now. Tech seems like it's getting beat up, and especially given the fact that recently the Fed Chair Powell said that he might not actually keep lowering interest rates. And now people are saying, uh-oh, what do you mean you're not going to lower interest rates? Because inflation is still around 3%. There's still enough money out there that there's inflationary pressures. If you lower interest rates too much, then inflationary pressures hit again, and that creates more economic strife for especially the middle class and lower middle class. So we have to watch all that. I think Powell at least tipped his hand and said, hey, this is what we're looking at. And I think people are saying, you know what, it might be time to regroup, count our many blessings, take profits before the end of the year so we can call our year a good year and enjoy the holidays without having to worry about losing half a year of state in the next market crash, and then maybe starting over. So that's kind of the focus that I think a lot of the smart money's doing. I mean, we're trying to be smart money. We follow the smart money. We see the selling. We're definitely concerned by it. That doesn't mean we're not in risk, but we're only risking the money that people can afford to risk, not the money that they need to live on.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about current event headlines. And if you're looking for a financial advisor who is not asleep at the wheel, who is up early, 2 o'clock in the morning, looking for opportunities that will help you in your journey towards retirement, again, you want to talk to Jeff. 520-780-9059 is our telephone number. If you'd like to set up that consultation with Jeff, you can make that call right now. Shelley will take your information. She'll give you a call back during the week and set up that appointment for you. Once again, it's not going to cost you anything. Entirely complimentary. 520-780-9059 or online at premret.com. Jeff, let's move on to our next topic here on today's show, wealth protection and risk management. When we talk about wealth protection, Jeff, especially for high-earning professionals, what does that really mean? I mean, what are the biggest risks that people underestimate?
Well, I think they underestimate the fact that the market goes down way faster than it goes up. It takes years sometimes to earn a good return on your assets, and it takes days or weeks sometimes to give it all back. And we've seen 6 months of gains in a lot of stocks be given back just this last week. We have to keep in mind that it can be ruthless, and you never know when the market corrects. It could be years before it gets back to even where you were. So many times we get this idea that, oh man, I got to get out. Oh, this is terrible. This is really hurting my gut. I got to get out, but I'm going to wait till it bounces back and gets back to even before I get out. I hate to say it, but that might be years. You know, if you did that in 2008, you would have waited till 2014 or 15 to get out. You would have rode it all the way down and all the way back up. It would never have happened. So do you really want to do that? Or do you say, hey, I was up 40%. I just gave back 20. I'm still up 20. That's still a good year. Let's take the profits and be happy. And let's be careful with our money. And again, that's if you are in a place where you're not afford to lose anymore, or you want to start taking some of the profits to protect the principal for your retirement plan. And I don't know if that answered your question, but that's just one of the things that came to mind.
Jeff, as it relates to our conversation here about wealth protection and risk management for high net worth individuals, physicians and business owners are often told that they have a target on their back. Why are these groups so vulnerable from an asset protection standpoint?
Well, I think every scammer wants to get at their money. They know that these people you're mentioning make high income, and very often a person smart enough to get through law school, med school, pass a CPA exam, etc., aren't necessarily the most informed when it comes to investment opportunities or how everything works. They're really good in their field. I wouldn't go to an accountant to do surgery. I'd go to a doctor, but I wouldn't go to a doctor to give me financial advice. Because quite frankly, most of them that I meet, the smart ones, come in ready to understand that somebody might be smarter than them about financial matters and things that they don't focus on every day. These guys live and breathe, just like I do money. They live and breathe healthcare or legal or other things. And so I think they're easy. They don't want to appear ignorant or less smart than they really are. And so I think they can be taken advantage of by a good flim-flam man and a salesman who pitches a good thing. And they don't want to act dumb and say, oh, no, I don't think I want to do this, because they don't understand it. They want to pretend they understand it sometimes. I think maybe it's just ego sometimes. And I have that too. I don't want to feel stupid. I want to feel like I know what I'm doing. And I know that's gotten me in trouble several times in areas that I'm not really that familiar with. And I've been taken advantage of. Shoot, I bought a timeshare even. Yeah, even me. So all of us can be taken advantage and get caught up in the hype, and we think we're smart enough to understand, and then we find out, we wish we wouldn't have done it. I'm not saying timeshares are bad for everybody. I just think that they're one of those things that don't count as a really good investment unless you use it a lot, unless you really love the vacation where you buy it. Many of my clients do, and I do actually enjoy it, so I shouldn't have probably gone there. But when it comes to retirement plan, you stick your money into this brand new real estate investment that's going to generate 20% per year and blah, 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 and then it doesn't. And your money's tied up, you find out you only get 30% of your money back. And you're like, what happened? I thought this was safe. And the guy who sold it to me said it was safe. Maybe the guy who sold it to you even thought it was safe. But the bottom line is sometimes we get caught up in some investments that are kind of alternative investments that are more based on hype and a good salesman than doing the due diligence and research. So I think some of these high net worth people really don't have time to do the due diligence. They need to find somebody they trust as they need to be in order to truly be a good fiduciary advisor for those people. I think people don't look hard enough maybe, or they just trust the first guy that sounds smart. I think sometimes we can be a little over trusting. So be careful. Do some tire kicking and do some due diligence. Make sure you feel comfortable with the things you invest in. Make sure you understand how they work. You don't need to understand everything, but at least get a good idea of the summary of the data or the bullet points that make it work, so that you understand it, feel comfortable going forward. Otherwise, you can make mistakes.
Talking with Jeff Olgan on Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about high net worth individuals here, wealth protection and risk management. If you fall into that category, you're looking for more than just a standard financial advisor, but somebody who really does understand the challenges that you may go through. The fact that you may have a target on your back, call us here at Premier Retirement. Talk to Jeff Olgan about this. 520-780-9059 is our number. You can make that call right now if you want. Leave your name, telephone number. Shelley will call you back during the week, and she'll set up that appointment for you at no cost and no obligation whatsoever. It's just a casual conversation between you and Jeff to talk about your needs, your wants, your desires, and your goals. Again, it's not going to cost you a dime. 520-780-9059. You can also find out more about the firm online at premret.com. That's premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we'll continue this discussion, but we'll also answer listener questions and more when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Olgan and Jeff Shea.
Thank you so much for making this a part of your weekend. You're listening to Premier Retirement with Jeff Olgan, founder and president of Premier Retirement Planning and Wealth Management. If you've heard the show today, you are not having these sort of conversations with your current financial advisor. Maybe it is time to get a second opinion. You can do that by calling 520-780-9059. Talk to Jeff Olgan here at Premier Retirement. It's not going to cost you a dime to do that. Wouldn't you like a second opinion about your retirement income? And certainly you want to talk about your individual needs. No cookie-cutter approaches here at Premier Retirement. 520-780-9059 for that complimentary consultation. Also online at premret.com. Also want to remind you that we're on the air for you 4 times a week, Saturdays at 7 and 9 a.m., also 1 p.m., and then on Sundays at 11 a.m., and 24/7, 365. We're on the podcast there. Go to wherever you get your podcasts. Search for Premier Retirement with Jeff Olgan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Okay, Jeff, always love hearing from our listeners. And let's start off our question and answer segment this week with Jim listening to us in Stone Canyon. Jim says, I'm 58 and have done well with my business. My net worth is about $3 million right now. My goal for my money is to provide a retirement in which my wife and I can travel the world in style. But we also want to leave our 2 children a nice inheritance. To me, stocks and bonds are boring and somewhat predictable. I've heard that the smart money is in private equity and private credit. What's your opinion on this?
Well, private equity you can get if you're an accredited investor, and obviously you are with that net worth, and you could go out and look for things that are already set up, basically a portfolio of assets. Sometimes they resemble REITs, real estate investment trusts. Sometimes they invest with a whole bunch of debt, basically. Most private equity is basically private lenders that are willing to give quick and easy loans to companies that don't have to go through the rigmarole of qualifying and doing all the paperwork and having the audits and the scrutiny that a bank would require. So they're willing to pay higher interest rates, typically for more short term. I know one private equity that our company invested in, one of their cool things they did was they basically loaned diamond importers money on the diamonds. They collateralized the diamonds, but they just get them here quicker, would get through custom quicker. And there was always such a markup. They always made easy money. And so it was like, okay, well, that's a pretty safe investment and it's backed by collateral. Some private equity, I just used that as it came to mind, but it could be real estate loans. It could be factoring for maybe somebody gets a lawsuit and they're waiting for their settlement and they know they're going to get it. It's just paid over time and somebody wants money up front. Maybe the private equity buys that note and then they get paid the Philip Morris money or something like that that's going to come in over time. Or Corning, there's another big suit that everybody heard about, and some of the other things that are out there. But private equity is an asset class. Sometimes it actually resembles a mutual fund. And the organization that I belong to, between us independent offices that belong to it, have, I think, somewhere in 120 to $150 billion in assets. I don't know where it is right now under management across the country. And we have a lot of buying power. We can go out and say, hey, we need a private equity firm to create a ticker symbol for us. And we can actually put it on Fidelity and trade it and get in and out of it with sometimes limited liquidity. But you can participate in private equity that way. Typically, it's not something you can just buy off the shelf on a retail account, however, so you can't do it yourself. You probably need an advisor to get access. Or you need to find somebody at the golf club that's into private equity. He can introduce you to his board of the members, and you can do a private equity investment yourself. However, keep in mind that these things often are not liquid. I prefer the ones that have a ticker and are tradable on an exchange, held at Vanguard, Fidelity, or one of the big custodians. But private equity is something that you can look for. Now, I do a lot of private equity personally. I loan money on real estate sometimes. Somebody needs to get in quick and can't qualify or has too much property, they're property rich and asset poor. My son was in that business, so he turns me on to people sometimes. If I have a little cash laying around, I'll invest in that. It takes a little bit of work and due diligence, so that is like a job. So I don't know if you want a job in retirement. You might want to just let things ride. I know you said stocks and bonds seem boring. I don't know. There's not a lot boring. That's what I get up in the morning early for. Is that the thing that isn't boring is all the insured products that are principal protected that give you guaranteed income that help you live life on your own terms that you don't have to watch, you don't have to get excited about. But if you're looking for something that gets you out of bed in the morning, honestly, I don't think private equity is going to be that either unless you're out looking for your own deals. So again, you can look for your own deals. I don't look for my own deals. I don't have time for it, but I have people bring me deals. So, maybe you can get in a place where that happens and you can find somebody that has deals or somebody that's in the market that maybe is doing fix and flip houses and needs money once in a while. Maybe you can do a private equity deal with that person or something like that. Or just people that need loans, and you can usually charge high interest because they need it for a short time. It's a convenience factor, and that might excite you or give you something to do in retirement that's more fun to do. Use your other half of the day after golf to do or something, whatever it is you do. Private equity, it comes in many forms. There was a big article just this last week. Wait till you see what happens to private equity. There's a lot of defaults and there's a lot of bankruptcies going on with businesses because the economy really isn't what it looks like it is or what it's hyped to be on the news. We're also looking at tariffs really are hurting some companies, and they're basically sifting out the men from the boys. There's a big day of reckoning coming on who's got too tight of profit margins and who can't borrow money, and the people that have bigger profit margins or the people that are big enough to borrow money easily from banks and collateralize their loans are continuing to overcome some of these extra pressures on the bottom line, and some of the smaller companies can't. It's typically the smaller companies that are dealing with private equity lenders. And so I think going forward, just based on the way the market is right now, I would be very cautious on any private lending, even in the real estate market, like I was mentioning that some of my clients do. But there's going to come a day when if the market does correct and the real estate market follows, there may be a big default risk. So be careful no matter what you do to get involved in that. I would say if you've got $3 million in your retirement and you're living off of it, I would not put any of that money that you can't afford to lose. I mean, I would still consider private equity, whether it's collateralized or not, whether it seems well run or not, I would still consider it risk money because there's always default risk. And default risk usually follows market risk and things like that that are staring us in the face right now. So be careful moving forward. I would be a lot more confident recommending you get into private equity with a small portion of your assets, maybe 10% of everything, after you've put 2/3 of it in principal protected assets that generate close to, let's say, $100,000 a year guaranteed. So you don't have to worry about missing your next meal or missing your next vacation or missing your next trip to see your kids or grandkids. At least get the income part solid and guaranteed then go risk your money on things that are exciting to you, like stocks, bonds, stock picking, day trading, private equity, whatever it is. Make sure the basis, the foundation is set. The last 5 or 10 years, people who have retired in the last 5 or 10 years, and if you're in that boat, you really haven't experienced a market correction while you haven't had a paycheck coming from a job. If your paychecks are coming from your portfolio, market corrections have a whole new meaning, and you'll find out the hard way if you don't imagine it, understand it, and realize what it would mean to you if half your net worth was gone one day because it was all in the market, or because the private equity firm went out of business and wasn't able to collect the money that was owed them, which is the money they owe you. So again, caution, always protect what you have. You worked a long time. You've done well. You've been smart enough to save a few $1,000,000 for retirement. Don't risk it and don't lose it by making silly decisions.
Jim, we appreciate that question. And of course, if you want to talk to Jeff, you can get in touch with him a couple different ways, really. You can call 520-780-9059. And because you're in Stone Canyon, you might be able to hook up with Jeff on the golf course there, too. So look out for Jeff there. Again, no cost, no obligation. He would love to talk to you. Okay, Jeff, let's move on down to Vail right now and hear from Linda. I always like Vail. They got the two big railroad spikes there that form the big V there. Vail was a stop along the Pacific Railroad for water, but nevertheless, Linda is listening to us. Linda says, I'm a 63-year-old woman. I was forced into early retirement. I have no debt except for my house. I have $600,000 in my 401k, most of which is in a Roth 401k and the rest in a pre-tax account. I also have $55,000 in a Roth in a brokerage firm. Now that I've been laid off, my advisor has encouraged me to move all of my money to his brokerage firm. I asked him to run the financial scenarios for me and how much money I can safely take out of my account now that I'm retiring early, quote unquote. I feel good about what he's sharing with me, but I'm nervous about all my money being in the hands of one brokerage account. I still have horrible memories of the Bernie Madoff scandal with people losing all of their money with one person. When I voiced this concern with a brokerage guy, he says he understands, but then he says he can't guarantee the returns if I leave some of my money in another account. Is there any way that I can protect myself from this? How should I proceed?
Well, I'm kind of of the same persuasion. It's really hard to be a good fiduciary advisor if you got 3 other advisors talking in your ears and doing different things with your money. I don't know what role I have to play. If you're going to quarterback the team and I'm on the team, but I don't know what the other players are doing, that's difficult. And honestly, most other advisors don't want to work with each other. I understand that all eggs in one basket are all with one advisor. I think you need to find an advisor you trust. Bernie Madoff was actually Ponzi scheming the money. He was just taking the next influx of money and falsifying records and things. You know, if you have an account, and it wasn't an account at Fidelity or some big firm that you could just log in and look at. It was Bernie Madoff, and he was just printing out statements and things. It was kind of it wasn't really high tech. It was kind of old school. And everybody just trusted him and believed him because he was walking around and hobnobbing with big charities and things like that. And everybody trusts a charitable guy, I guess. Kind of like they trust every accountant. They trust every charitable guy. Some of them are great. Some of them really don't know what they're doing. No offense to accountants or charitable guys. But the bottom line, sometimes we don't really do the due diligence and we just jump in there. Same with financial guys. There's a lot of people that just really are uninformed, or they get the direction from maybe somebody on Wall Street that tells them what to do every day, and they really don't have a mind of their own, and they really can't appeal to your own interests or your own values or even supply the services that you need because they're not offered by the firm. So I think what you need to do is make sure the firm, if this person is just moving your money from a 401k and managing it in a similar asset allocation that he gets a fee for, but you like him being there and holding your hand and answering questions, then maybe he's the right guy. But keep in mind, if all he has is stocks, bonds to offer, you're still at risk. And if he says the word guarantee, that if you move it someplace else or split it up, I can't guarantee you these returns. Well, if they're securities, root word secure, not secure in reality, that's a kind of an illegal, uncompliant way to describe income. You cannot guarantee, even if you use the rule of thumb, like a 4% rule, there's no guarantee of income unless you're using principal protected assets. And those are typically offered by insurance companies. And that's why we straddle the fence a little bit. We have one foot in the market, we have another foot in safety. And the safety things are those things that are insured, secured, and backed by some sort of not just assets at the company, but also a level of insurance beyond that. And that's where we like to put assets. And the reason I don't work for a big name firm, I have my own, it's Premier Retirement Planning and Wealth Management. Premier Wealth Advisors is my registered investment advisory. The reason I started my own is because I didn't want to take directions from a big company. I didn't want to be limited in scope by what they would let me offer. Most broker dealers only want to deal with Wall Street products, stocks, bonds, and cash, and say, don't worry, hold on, ride it out. as a fiduciary, you should be allowed to do what the client wants. And if it's to protect some assets by insuring an account, in principle protecting it, and offering income that's guaranteed regardless of how the underlying asset performs, which stocks, bonds, mutual funds, ETFs can't do, then you need to be able to work with somebody that does that. And I think if you saw a comprehensive plan like the ones we offer, and I guess I'm probably not the only one, I'm only one I know who does it as well as we do, obviously. I'm a little biased, but we do comprehensive planning. We use all the buckets. You can use one advisor, but your money is not going to be in one bucket. I'm going to quarterback the team. We're going to play offense. We're also going to play defense. We're going to have both sides of the field covered, and you're the owner of the team, and you could even be coach. But, if you want me to quarterback it, I can't run every play and do everything. I can't pass it to myself. I've got to pass some of these assets on to another player who can take care of them, who watches them every day, who protects the principal, who gives us better than typical fixed money or safe money returns, and can guarantee you income so that your paychecks are taken care of from now till the time you pass away. So you never have to worry about where your next meal is going to come from, or whether you have enough money in the bank to take that trip you want to take, or to fix the air conditioner when it goes out, or to wine and dine your kids when they come to visit. You want to have that guaranteed income and not be subject to the next market crash and say, oh, sorry, kids, you can't come out, or I can't afford to fly. The market's down 50% and I have to wait till it comes back before I can afford to do anything. Because if I keep spending money, I'm going to be locking in losses. I can't afford to do that. Well, you might only find out about that after it's too late. After the market crashes, they say, oh, wow, this isn't, by golly, that broker really didn't guarantee my income. Doesn't look like we're going to make it here. If I keep spending money, I might run out if the market doesn't rebound quick. Then where are they? Hey, the market does what the market does. Don't worry, it always comes back. They always say the same cliche stuff, but does it really work? No, not unless you have principal protection and income guarantees on some of your money. The money that you need to live on needs to be guaranteed. It needs to be in a place probably different. And I'm sensing that your advisor was probably advising you in the market with your 401k that wants to just move it over with his firm, may do just the same stuff, just you pay him the fee instead of the 401k company. So be careful. Look for more comprehensive plans. I would see what he has to say and compare it to other plans around town. Come see people like us that are more independent, that can work for you, not for a company. And you might find a different flavor, something that makes you a little happy, and understand that just by dealing with one advisor where you have all your money managed at that firm, and by the way, you can unmanage it with that firm anytime if you don't like it. You may have different asset mixes, access to different asset classes, access to different strategies that are tax efficient, access to tax planning, and even a CPA to do your taxes. We have all that here. Consider the source. I would be very concerned if I was just going into a place where I was just going to throw it to one guy to do stocks and bonds, and he's telling me that he can guarantee me income if all of it's there. It might sound a little self-serving off the top to me, but again, I haven't seen the plan. It might be a good plan. Come in and we could compare if you want. At least go around, kick some tires with 3 or 4 other planners before you make the final decision.
Linda, we appreciate you listening to us in Vail and having the confidence and trust in us to send that question in. Again, 520-780-9059 is our number. If you would like to have a conversation with Jeff, it's just a casual conversation. Again, it's 520-780-9059. Okay, Jeff, let's stay south of town here. Let's head out west on Swarita Road, and we're going to end up in Swarita where John's listening to us. And John says, I'm a 51-year-old married man and pay about $200 a month for a $1.5 million life insurance policy offered by a private professional group. I also have $500,000 in term life insurance from my employer. I'm 5 years away from financial independence. At what stage should I reduce or stop paying for my term life insurance? Many thanks.
Well, I think the term life insurance is going to end up going up every time it renews for another term. If your death would cause someone serious financial harm or to have to live at a deficit in income, a significant deficit in income, then keep it until that deficit goes away. And the older you are, the less years somebody would have to live. Like if you died today, a spouse or anyone you care about that you're supporting would lose your Social Security or lose some assets, maybe pension or other things. So if you want to have that person live with the same lifestyle, then you might want to buffer that by keeping that term policy. I don't know how much it is. I don't remember you saying, but it might be worth keeping until you're 70 or maybe even 80 if you bought a 30-year term when you were 50 years old, and the price can stay the same. But I will guarantee you when you're 70 or 80 and you want to renew that term, it's either not possible to renew it or it's going to be super expensive where you're not going to be able to afford it. So term is cheap and it does its job if you die early, but almost all term policies don't pay death benefits. Very few do. I mean, they're meant to run out before you die, but they're also meant to be there just in case. And it's always better to have it and not need it than need it and not have it. So that would be my answer.
John, thank you so much for listening to us in Sahuarita. And of course, you can always call Jeff at 520-780-9059. We'd be more than happy to have that conversation with you, no cost and no obligation. If you got a question you'd like us to answer on the air, you can get it to us by calling it into Shelley if you want, 520-780-9059, or you can go to the website, which is premret.com, premret.com. Use the contact page, and we'll be happy to answer it for you on the air. Again, if you'd like to have a casual conversation with Jeff, no cost, no obligation. Again, that number, 520-780-9059. Jeff, I know here at Premier Retirement, you do a lot of work with high net worth individuals in our area, and long-term care strategies for family with large estates is one of the things that you do help people with. Long-term care is a major risk for all retirees, but I think especially for families with large estates. What makes it such a threat to wealth?
I think long-term care is, no matter what asset class you're in or whether you're a large estate or a small estate, long-term care can break you. Probably not a big estate, probably can't break you, but it can still whittle away at your funds. Some of the super low income people can get on Medicaid and have government pay for your benefits. Some of the middle class people have paid for years and years for long-term care policies, and the insurance keeps going up, and pretty soon they have to drop it and end up not able to use insurance and have to pay assets out of their own estate or mortgage their house or do a reverse mortgage or something so that they can pay for long-term care in the end. Long-term care is typically the second biggest expense, at least for the majority of our clients, taxes being number one. I think taxes and long-term care being the top two expenses definitely need to be spoken for. In some cases, people have a big house. I have several clients that just came in this week. In fact, we're starting to get near the year end and doing our annual reviews. And I have several clients that don't have kids or have kids that are so well off they don't need to worry about leaving them a legacy. And, their house is going to be the long-term care plan. In fact, somebody say, yeah, but I don't want to get sick, find out I've got Alzheimer's, have to go long-term care, and then I can't do a reverse mortgage or get equity out of my house. Or I might not want to downsize because my spouse wants to keep living here, or maybe I want to live here. You can do a reverse mortgage where you actually get a credit line and you basically have it. You don't even have to use that credit line. But the equity in your house can be available to you at a drop of a hat at a moment's notice, like just writing a check on your own bank account, and your house equity, your home equity can be your bank account. As long as you're over 62 years old. And Jordan, my son, is in the Mesa office. He's got a background in mortgage and real estate. And so that's what he brings to the table. And he helps people unlock the equity in their home for long-term care so they can use all their money in retirement as footloose and fancy free as they want, to the degree that it's responsible, obviously. But some people are like, how do I cover long-term care? Well, your house might be your bank. And you can basically set up that long-term care plan without forking out money on an insurance plan that you may just lose that money for because you never use it, or because it becomes so expensive you can't cash flow it anymore when you're 80 or 90. I've seen that happen far too often with too many plans. The other thing for high net worth individuals, because they typically have a tax problem as well. You mentioned the high net worth person of having long-term care. I don't really think the long-term care hurts them as much as all the taxes they pay. But what if you could kill two birds with one stone and have a tax plan that also cover your long-term care? And that's why I love LRRPs. There's some guys on the radio that go, oh, LRRPs are stupid. Well, if you compare them to a mutual fund and look at the long-term history of how much they grow, if you just start to finish and never touch them, yeah, a mutual fund will probably beat it. But if you look at how much cash flow you can get out, how much taxes you can save on that tax flow, you might find out that it beats a very good mutual fund account or even a Roth IRA that's invested aggressively. Has less volatility, has a death benefit as part of the cost of doing a LRRP, but that death benefit doesn't have to be paid when you die. You can actually use most of it up while you live by spending it tax-free. And when you die, that death benefit basically just pays off everything you spent during your life rather than wait to make somebody rich by dying. You can also save that death benefit or a portion of that death benefit to after you've used some cash flow that never shows up on a 1099 that you get to spend in your retirement, and then still have maybe $500,000 left in that account to use for long-term care should you get terminally ill. And you can stay at your own house. All you have to do to trigger it is just not be healthy enough. You have to be unhealthy enough to get the benefit, but you don't have to go to a nursing home. You don't have to go to an approved assisted living facility. You don't have to have so many visits with a doctor or rehab or go through all the hoops that insurance companies make you do before they pay claims. You can basically say, hey, look, I can't do 2 activities of daily living. I want my money, or I want my money to be paid out at a much more rapid rate, and I can use it up before I die. Just give an example, this guy that had a $3 million estate earlier, and he doesn't think the stocks and bonds are exciting enough, wants to do private equity. My thought was, let's not even look at private equity. I'll show you something that's kind of exciting, in my opinion. What if you put a third of that in LERPs, one for you, one for your wife? And let's say you put $500,000 in, you got 1.2 to 1.5 million in potential death benefit, which is tax-free cash flow over the next 20 or 30 years. And let's say you used $1 million of it each over the next 20 years, and then you had to go to a nursing home. Well, maybe the remaining 500,000 would be available for long-term care. Oh, and by the way, remember the other 2 million you have? That could be growing in the market. That could be producing income in an annuity. It could be saving it aside for a legacy for your heirs. You could be gifting it to them while you live, whatever. The bottom line is all the income. By the way, if you took $1 million in income out of that LERP over the next couple of decades, that income never shows up on a 1099. It doesn't affect your IRMA for Medicare premiums. It doesn't affect your tax brackets. It doesn't take away from your standard deduction, doesn't take away from the deductions you might be able to get on direct contributions to charities and other things. So bottom line is it has so many additional benefits other than just the fact that it is principal protected and tax-free. The steady growth on it will outperform most other safe investments. And although it's not guaranteed, it's got a pretty good history of performing. You can back test it and see what history has done with these things. And I believe in them a lot more than doing a pay-as-you-go long-term care policy or just setting aside cash that you don't get to spend and don't get to use, that you have to liquidate something later in order to pay for it. So again, a couple of different options there. A reverse mortgage, you can get a credit line against your house and pay for it, and that's tax-free. If you're healthy and younger, you might want to consider a life insurance version of a tax-free bank account that would cover long-term care and give you tax-free income as you need it throughout retirement.
Jeff, I'm sure based on a conversation here that our listeners may have some questions. If that is you're concerned about long-term care, whether or not you're a high net worth individual or not, you want some clarity on that, give us a call here at Premier Retirement at 520-780-9059. Talk to Jeff about this, no cost, no obligation. We'll find a solution for you. 520-780-9059. You can also check us out online at primret.com. Well, Jeff, we just get started and we run out of time. So for Jeff Ogan, I'm Jeff Shade. Thank you so much for listening to us. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.